Stocks of Rogers Communications Inc. sank by over 4% on Monday after Canada's competition regulator announced that it's looking to block the telecom giant's plan to buy Shaw Communications. Notably, SJR.B stocks also tanked by over 7% at the close on Monday. The Competition Bureau has said in a statement that it's seeking to pull the plug on the proposed $26 billion acquisition deal to protect Canadians from increased prices, poorer service quality, and limited options, mainly in wireless services. So what could this mean for the billion-dollar deal and investors of these telecom giants? Well, there are a few things to bear in mind. Canada's telecom space is largely ruled by the big three, that is, Rogers Communications, BCE Inc. and TELUS Corp, which reportedly cater to about 87% of Canadian subscribers. Shaw Communication, though a fairly new player in the field, has made its presence felt with its services and competitive prices. It's said to be the fourth top wireless service provider in the country, serving some 2.1 million customers spanning Ontario, Alberta, British Columbia as well. The Competition Bureau, in its case the Competition Tribunal, argues that if Shaw is removed, it'll take away a low-price alternative and prevent future competition in the wireless service market. It also notes that Shaw's absorption into Rogers threatens to reverse the progress it made in the already concentrated wireless services market. The regulator claims that during its probe, it found that Shaw had new business plans lined up for wireless service markets, 5G networks, etc. prior to the merger announcement. And since the announcement, which was made in March last year, the telecom player's investment in its network has shrunk. Marketing and promotional activity has reduced, and in turn, this has led to a general loss of competition in the market. Now, apart from approaching the Competition Tribunal to block the Rogers-Shaw merger deal, the Competition Bureau is also looking to get an injunction to stop the closure of the deal until its application is heard. Following the Bureau's statement, RCI.B stocks have slipped into the red zone and closed at 64.19, while Shaw stocks ended lower at 34.87 apiece. The companies have responded to the Competition Bureau's opposition on Saturday, saying they remain committed to the merger plans, which they claim will have significant long-term benefits for consumers, businesses, and the Canadian economy. Despite this, neither of the firms have acknowledged the regulator's latest statement just yet. Rogers' plan, as proposed in March last year, is to purchase Shaw's outstanding shares for an additional price of $40.5. And comprising the assumed debt, the merger amounts to about $26 billion. Now, the case against the merger is currently expected to go either way for Rogers Communications and Shaw. And if it fails, some market experts project that the stocks of both these companies will feel the impact, although Shaw could see some boost in popularity. But if the acquisition is successful, however, Rogers stocks can surge in the wake of becoming a bigger entity with wider resources and reach. Either way, investors are likely to see this battle stretch out over the coming months, where both telecom stocks could face some friction in the market. More updates to follow. I'm Holly Shields for Campaign Media.